In this week's video, we'll review charts that tell us why a 2008-like plunge in stocks is not likely. What does a pre-plunge market look like? To answer that question, we'll look at charts in 2000 and 2007 and compare them to the present day. We'll also look at a setup on the chart of the VIX. The last time the setup happened, the S&P 500 advanced an additional 177 points. We'll look at a summary table for the market model, and we'll also review these bullets in this week's video. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We'll open this week's video by comparing the peaking process in the S&P 500 in 2001 and 2007 to the present day. This is a daily chart of the S&P 500. This is August of 1999 where my cursor is. We've got the 50-day moving average here in blue and the 200-day moving average in red. If you're relatively new to technical analysis, the 200-day moving average is used to monitor the longer-term trend, and the 50-day moving average is used to monitor the intermediate-term trend. What we want to avoid from a bear market perspective is a move like the one that occurred here in October of 2000. From this point here to this point here, the S&P 500 dropped 25%. How likely is it that we get a 25% drop similar to this one in 2001 in the present day? And we'll answer that question using the next three charts. You can see here, prior to the plunge in 2001, the S&P 500 went sideways for 10 full months. This point here is identical to this point here, which occurred 10 months later. And prior to the market rolling over, you can see the slope of the 200-day moving average is really not that steep. It starts to flatten out here. And we also have a 50-day moving average here that touches the 200-day, comes back near it here, and is relatively close to it here. Prior to the 25% decline here, the slope of the 50-day moving average rolls over, and this pink arrow shows you the slope of the 200-day moving average. This is a major red flag here where the slope of the 200-day rolls over, warning us of this type of decline. We also get what's known as a death cross here. The S&P 500 is all the way back up to this point here. So this death cross occurs prior to the 25% decline in the S&P 500. We get a market that consolidates, goes sideways. We get the 50-day crossing below the 200-day, and the slopes of both moving averages roll over. We're reviewing the exact same concepts. Now we're looking at the plunge in 2008, the point of the exercise. We want to know how likely is it that the stock market in the present day drops 50% as it did from this point here to this point here in 2008. You can see prior to the decline starting here on the right side of the blue box, yellow flags were waving in the S&P 500 for 8 months. This point here is identical to this point here, which occurred 8 months later. This is the battle taking place between economic bullish conviction and economic bearish conviction. And in this box here, the battle is roughly equal. No one's particularly winning the battle, and then we get a breakout in this direction. Also helping us understand that the probability of a sharp decline has increased early in 2008 is when the 200-day moving average starts to roll over here. The slope is negative here. It's positive here. We get our death cross here, just as we did in 2000. This is the 50-day moving average crossing below the 200-day. And also notice how close the 50-day is here to the 200-day. And notice how close the 50 is to the 200 in this point here. This is telling us in this range here that we have a very indecisive and flat trend, foreshadowing this big decline here. Look at the slope of the 50-day here, down. Slope of the 50-day here is down. Again, foreshadowing this decline. The slope of the 50 down here, the slope of the 200-day down here. We're looking at the same concepts now. Now we have the present day 2013 as of the close on Friday, November 29th here on the top. This is the chart from 2001 that we looked at. Again, we're trying to avoid risk like this where the stock market drops rapidly. You'll see here, there's your slope of your 50-day warning you. The slope of the 50-day recently has been improving, and it has a bullish slope. This slope here, the 50, looks nothing like this. Here we said that the 200-day was flattening out and it rolled over. This was a big yellow flag about a vulnerable stock market. You can see the 200-day here in red. In the present day is not flat. It's not rolling over. The other thing to notice is notice the distance between the 200-day and the 50-day. Here it gets closer and closer and closer and tighter. That's not what we have here. We have a 50-day that's been moving further away rather than closer to the 200-day. Also notice sideways consolidation, roughly an even match between bullish and bearish conviction here. This is a 10-month period. It says if the present day were similar to this chart, this is 10 months back here. It says that the stock market today would be down all the way around 1,500 if we had a trend that was as weak as it was during this point in 2001. Now we're comparing the present day 2013, again as of the close on Friday, November 29th, to the 2008 chart we just studied. No progress here for 8 months. This box here shows us 8 months in the present day. It tells us if the present day trend was as weak as it is at this point here, where the stock market is very vulnerable to a quick plunge, we would be at this point here. We would have made no progress over 8 months, and the S&P 500 would be trading around 1560. Here, the 200-day moving average is rolling over. The 200-day not rolling over. Much stronger, longer-term trend is what this slope tells you when we compare this trend to this trend. Here, we had the 50-day moving average rolling over twice recently. We really don't have that anywhere here. The worst we've seen is a little flattening out. So this is a yellow flag with the 50-day, a yellow flag. The present day 50-day has been strengthening and turning up, which is indicative of an improving intermediate term trend. We don't have a death cross as we did here, waving a big yellow flag before this plunge. In fact, the 50-day has been moving further away from the 200-day moving average. What this tells us is if weakness and consolidation started in the stock market this week, which it may, it would probably take some time, and we would experience some ups and downs and some volatility before the probability or odds shifted towards risk in this fashion where the stock market could fall rapidly. The moral of the story is the present day trend in 2013 is much stronger than it was at this point in 2008 and a similar point in 2000. Investors need to be able to answer these two questions. How will I handle a stock rally that lasts into 2016? How will I handle the next 50% decline in stocks? Our answer to those questions is the CCM market model. Now we're going to shift gears and look at the current reading of one of the submodels that feeds into the master CCM market model. We'll look at a summary table for the CCM correlation model. If you're relatively new to the fold, this is the summary table for the CCM correlation model. These are the indices or risk-on, risk-off ratios that are used in the model. These are the ones that are the most important due to the fact that they have a stronger correlation to the direction of the stock market. These are less important. You can see here, this 99% tells us that 99% of the answers to the binary questions asked in the model are coming back bullish, and or hurdles that need to be crossed within the model have been crossed. So what this tells us is the observable evidence is unequivocally bullish. The way the model works, we don't know how long this will last. We stay with the bullish trend as long as the observable evidence tells us to. If the evidence begins to shift, we'll shift our allocation accordingly. We do have some cracks that are showing, but nothing significant. Even the S&P 500 relative to the VIX is getting a 77% in terms of being returned on the bullish end of the spectrum. And we do see stocks above their 200-day moving average is also lagging a little bit. The average of these in blue is 99%. The median is the same. Still very bullish down here in purple. Moral of the story is something has to change for the stock market bears. If it does, we're flexible and we'll shift with it, and so will the market model. This is a monthly risk-on versus risk-off chart used in the CCM market model. The meat of the chart here is the S&P 500 relative to the VIX. When the ratio rises, that's what risk-on looks like, and the stock market tends to go up. When the ratio falls, it can foreshadow or coincide with declines or weakness in the stock market. The S&P 500 is shown at the top for reference purposes only. A few weeks ago, we showed a W pattern. It was actually a few months ago in the NASDAQ, and said that a breakout from a W pattern tends to be bullish from a probabilistic perspective. And as you know, the NASDAQ has done quite well since the breakout occurred from that W pattern. You can see here, late in 2012, we have somewhat of an indecisive or consolidation look in this ratio of the S&P 500 relative to the VIX. Here's our W. Here we come up to the top where you can see the breakout. Here, when the W of the ratio breaks out in a bullish manner, if we go up here, the S&P 500 tacked on an additional 177 points when the resolution for the ratio was bullish. Also notice, coinciding with the breakout was a momentum spike in MACD here. You can see the slope goes up. We have a similar consolidation pattern or indecisive look here on the monthly S&P 500 relative to the VIX. We've been watching this all month, but didn't show it in the past few weeks because it can be erased on a monthly chart. But now that we've printed the monthly close, this is etched in stone here, this breakout from the W pattern on this chart, etched in stone for the history books. You can also see here the black line for MACD says momentum is improving for the stock market relative to the VIX. We have a similar slope on the black line here. What does this mean? Does this mean that we expect the S&P 500 to tack on an additional 177 points from this point here? No, it doesn't mean that. In fact, this isn't a forecast in any shape, form, or fashion. It just tells us that the probability of bullish outcomes has increased and will stay favorable as long as this breakout from the W pattern holds on this ratio. This is a daily chart of the Dow Jones Industrial Average. You can see here the orange box. There's a 4-month consolidation period here, and during the consolidation, the 50-day moving average rolls over and comes back towards the 200-day. As the bullish breakout occurs here, the 50-day turns back up. You can see the slope is positive here. And then the stock market advances for 1, 2, 3, 4 months. We have a similar consolidation box here. This is a 5-month consolidation in the blue box and a 3-month consolidation in the orange box. During the consolidation period, the 50-day moving average rolled over and started to move towards the 200-day. Similar to this point here, we get the bullish breakout, and then the 50-day moving average turns back up. You can make an argument that this point here is similar to this point here, where the stock market subsequently gained for 4 months. This is a daily chart of the S&P 500 index. These are moving averages used in the CCM market model. You can see when the moving averages cluster, that's indecisiveness in terms of the trends. You get a bullish break. You can see we have white space between the blue and the red, and white space between the red and the green as a new trend starts. And subsequently, the stock market advances. Similar situation here. The MAs consolidate indecisiveness. We get white space and white space, slopes moving up, and subsequently the stock market advances. Consolidation here, indecisiveness. We get a break to the upside, space, white space between the red and the blue, white space between the green and the red. You can see the slopes turn up, and subsequently good things happen. Similar situation here, indecisiveness, consolidation. This look here is similar to this period here, this period here, and this period here, where gains in the S&P 500 followed. Just revisiting a chart we've looked at several times in the past. This is our XLY consumer discretionary relative to XLP. When the ratio rises, that's what risk on looks like. All things being equal, the stock market tends to do well from a probabilistic perspective. Here, when the stock market consolidated in 2011, the ratio had a negative slope and foreshadowed this decline here. Recently, the ratio has been rising and has regained its footing in recent weeks. The point we want to emphasize in this week's video for the same ratio, XLY relative to XLP, is we've got a 2.5-year consolidation period here in the orange box, and we recently had a bullish breakout to the upside. On a monthly basis here, the ratio made a higher high at the end of November. This is another chart used in the CCM market model. We're looking at IYM, Basic Materials Monthly. IYM is very similar to the XLB ETF that you may be more familiar with. Same concept here in this chart. We have a sideways consolidation that took place for 19 months here with very little progress. We recently had a bullish breakout to the upside. You can also see the moving average here in blue has a positive and bullish slope. Obviously, materials are economically sensitive, and a bullish breakout from a 19-month base tends to be a positive sign for the stock market from a longer-term perspective. Quick update here. We've got the momentum divergence that we looked at on a monthly chart foreshadowing this decline in the S&P 500. We've got a divergence here that helped foreshadow this decline. In the present day, we do not have a divergence. If anything, we have positive and bullish momentum confirming this 13-year breakout from a sideways consolidation period. The reason for showing it again, this is a monthly chart, and now we have a print. This is etched in historical stone since November has been completed. As longtime followers and listeners know, the market model answers binary and unbiased questions. Weekly S&P 500, the probability of bad things happening in the stock market increases when momentum drops out of overbought. We've shown this chart numerous times. We remain in overbought territory. All things being equal, good things tend to happen in the stock market when momentum is strong. We've shown this chart numerous times as well. You can get an explanation in previous videos on the Shavako Capital channel. Last week, small caps, growth-oriented small caps, made a new weekly high on a closing basis. IWM was up 1.48% last week. It's another chart we've shown in the past. You can see semiconductors, SMH, on a weekly chart. Resistance, rejected, resistance, it was rejected, rejected, rejected. Bullish breakout, tested it successfully, and the bullish trend continues. This is another chart we've shown numerous times in the past. This is the S&P 500 monthly resistance in the year 2000. Resistance in the year 2007, bullish breakout here in 2013, retested and it's held. The point of showing it on a monthly closing basis, you can see here we close near the monthly high. All things being equal, that tends to lean bullish. This is the monthly chart of the NYSE composite that we've looked at in the past. Again, the point of showing it, this is a monthly print now where we have a strong and relatively new trend here. This point here looks similar to this point here where the stock market continued to gain for some time. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.